Barbara is 67 years old. She retired from the post office after 28 years. She lives in Ohio on a pension and Social Security. Every April, she hands her tax return to the same preparer she has used for 11 years, pays whatever she owes, and moves on. Last year, she owed $900 in federal income tax. She should have owed nothing. Not because she did anything wrong, not because she was cheating, because 5 separate provisions in the tax code exist specifically to protect people in her exact situation, and not one of them was on her return. Her preparer never mentioned them. The IRS never sent her a letter. And Barbara, like millions of retirees over 65 right now, had no idea she was leaving real money with the IRS every single year. Today, I'm going to walk you through all 5. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Nancy, and you are watching Senior Wellness Hub. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Here is what makes this list different from what you will find anywhere else. These are not theoretical strategies. These are not things that apply to wealthy people with complicated portfolios. These are breaks the IRS built directly into the tax code for ordinary retirees, many of them automatic once you know to look for them. And almost none of them make it onto returns filed by people who do not know they exist. Tax break number 1, the additional standard deduction for age 65 and older. This one is the most basic and the most missed. When you turn 65, the IRS increases your standard deduction above and beyond what every other taxpayer gets. For the 2026 tax year, that additional amount is $2,050 for single filers and $1,650 per qualifying spouse for married couples filing jointly. If both spouses are 65 or older, that is an extra $3,300 sitting on top of your already higher standard deduction. Most people who have a preparer filing their return receive this deduction automatically once their age is entered correctly. But the number of returns where the age box simply is not checked is higher than you think. If you have ever switched preparers, used a new tax software, or had someone file your return in a rush, this is worth checking. And here is something almost nobody talks about. The same additional deduction applies if you are legally blind. If you're 65 and legally blind, you get 2 separate additions to your standard deduction, not one. They stack for a single filer who is both 65 and blind. That is an extra $4,100 on top of the base deduction. I have seen returns where the blindness box was never checked even when the taxpayer had a documented vision impairment. Tax break number 2, the senior bonus deduction. This one is brand new, and most tax preparers are not applying it automatically. The One Big Beautiful Bill Act, signed on July 4, 2025, created an entirely new deduction for Americans age 65 and older. It is called the Senior Bonus Deduction. If you're 65 or older, you can deduct an additional $6,000 from your taxable income on top of everything I just described. If you are married and both spouses are 65 or older, that doubles to $12,000 combined. This deduction is unique because you can claim it whether you take the standard deduction or itemize. That matters because most people on fixed incomes do not itemize. This applies to everyone. The income limits are $75,000 for single filers and $150,000 for married couples filing jointly. Below those numbers, you get the full deduction. Above them, it phases out gradually. It is claimed on the new Schedule 1A attached to your Form 1040 or Form 1040 SR. It is available for the tax years 2025 through 2028 only. After that, it is gone. Let me show you what these first 2 deductions look like together for a typical retiree. Take a married couple, both 66, both on Social Security, and a pension with modified adjusted gross income around $80,000. Their base standard deduction in 2026 is $32,200. Add the additional senior deduction for both spouses, $3,300, Add the new senior bonus deduction, $12,000. Their total deduction before a single dollar of income is taxed is $47,500. For a couple with modest retirement income, that alone could eliminate most or all of their federal tax bill. And yet, the senior bonus deduction is so new that the IRS itself issued a warning that not all tax software is applying it automatically. If you already filed your 2025 return without it, you can amend within 3 years using Form 1040X Tax Break Number 3, the Qualified Charitable Distribution. This one is not a deduction. It is something more powerful than a deduction, and almost no retiree who could use it knows it exists. If you are 70 and a half years old or older and you have a traditional IRA, you can transfer money directly from your IRA to a qualifying charity. That transfer is called a Qualified Charitable Distribution, or QCD. The money never touches your bank account. It goes directly from your IRA custodian to the charity. And here is what makes it so valuable. The amount you transfer does not count as taxable income at all. It does not appear in your adjusted gross income. It does not push more of your Social Security into the taxable zone. It does not trigger IRMA Medicare search charges in 2026. You can transfer up to $111,000 per person this way. If your spouse also has their own IRA, they can transfer another $111,000. And here's the part that matters for most retirees. The QCD counts toward your required minimum distribution for the year. Let me show you why this is such a powerful tool with a real example. Carol is 74 years old. She lives alone in Georgia. She has a traditional IRA, and she's required to take out roughly $14,000 this year as her minimum distribution. She also donates $2,000 a year to her church. If Carol takes her full $14,000 RMD into her bank account and then writes a check to the church, the entire $14,000 is taxable income on her return. Her Social Security taxation goes up. Her Medicare premiums could go up 2 years later. But if Carol does a qualified charitable distribution of $2,000 directly to the church from her IRA before December 31st, that $2,000 is excluded from her taxable income entirely. She still satisfies $2,000 of her required minimum distribution. The church gets exactly the same donation, but Carol's taxable income is $2,000 lower at her tax rate. That saves her real money. And if she was near one of the Social Security taxation thresholds, it could save her significantly more by keeping more of her benefits untaxed. The only mistake retirees make with QCDs is waiting until after they withdraw the money. Once you take the RMD into your bank account, it is too late. The distribution is already taxable. The QCD must be sent directly from the IRA custodian to the charity. Call your broker or custodian and ask them specifically for a QCD distribution form. Most of the major custodians, Fidelity, Vanguard, Schwab, now allow you to do this online or will mail a check directly to the charity on your behalf. The deadline is December 31st, not April 15th, December 31st. If you're planning to use a QCD to satisfy any part of your required minimum distribution for the year, the transfer must happen before that date. Tax break. Number 4, the medical expense deduction. Retirees are the single group in America most likely to benefit from this deduction. Clears throat, and most of them never claim it because they assume they do not itemize. Here is how it works. If your total unreimbursed medical expenses in a year exceeds 7.5% of your adjusted gross income, you can deduct the portion above that threshold when you itemize on Schedule A. The threshold is permanent law as of 2021. It is not going back to 10%. What counts as a medical expense surprises most retirees. Medicare Part B premiums count. Medicare Part D premiums count. Medicare supplemental insurance and Medigap policies count. Long-term care insurance premiums count up to certain age-based limits for someone aged 71 or older in 2026. The deductible limit on long-term care premiums is approximately $5,600 per person. Dental work counts, hearing aids count, vision exams, and prescription eyewear count. Modifications to your home made for medical reasons. Grab bars, wheelchair ramps, stair lifts count. Even mileage driven to and from medical appointments counts at 21 cents per mile for 2025. Here is why this matters specifically for retirees. If you have a pension of $45,000 and Social Security of $20,000, your AGI might be around $50,000. 7.5% of $50,000 is $3,650. Think about what a retiree on Medicare actually spends in a year. Medicare Part B premiums in 2026 are $2,134 per person for the full year. Add a Medicare Part D plan. Add a Medigap supplemental policy. That alone for many retirees is $5,000 to $6,000 before a single doctor visit or prescription. Add one dental procedure. Add new hearing aids, which Medicare does not cover and which cost thousands of dollars out of pocket. Add prescription copays. By the time you add it all up, a retiree with modest income on Medicare is often much closer to that 7.5% threshold than they realize. And every dollar above it becomes a deduction that the standard deduction never gave them. The mistake is assuming you cannot itemize because the standard deduction is so high. Snorts. With the new senior bonus deduction adding up to $12,000 for a qualifying couple, it is true that the bar for itemizing is higher. But if you have significant medical costs, you should run the numbers every single year. Do not file on autopilot. Tax break number 5, the credit for the elderly or disabled. This is the most overlooked tax break on this entire list. It has existed in the tax code for decades. It applies to millions of retirees right now, and the vast majority of the people who qualify for it have never seen it on their return. Here is how it works. If you are 65 or older, or if you are under 65 and retired on permanent and total disability with taxable disability income, you may qualify for a non-refundable tax credit worth between $3,650 and $7,500. Not a deduction, a credit, a dollar-for-dollar reduction in what you owe. The catch is the income limits. For single filers in 2026, your adjusted gross income must be below $17,500. For married couples filing jointly where both spouses qualify, the limit is $25,000. Those are low thresholds. This break is designed for retirees with very modest incomes who are still paying some federal tax. But here's the thing. A retired school teacher living on a modest pension and Social Security. A widowed postal worker whose income dropped significantly when her husband passed. A retiree living primarily on Social Security with a small IRA distribution. These are the exact people this credit was built for. And in most cases, their preparer either does not know the credit exists or assumes the income is too high without ever actually running the calculation. The credit is calculated on Schedule R and then transferred to Schedule 3 on your Form 1040. The IRS will actually calculate it for you if you fill in the right information and check the appropriate box in Part 1 of Schedule R. You do not have to do the math yourself. If you are in the income range where this credit applies, you can eliminate your entire federal tax liability for the year. Let me bring it all together. Barbara in Ohio, the one I told you about at the beginning, 28 years at the post office, $900 owed last April that she should not have owed. Here is what was missing from her return. The additional standard deduction for age 65, $2,050, not on the return. The new senior bonus deduction, $6,000, not on the return. Medicare Part B and D premiums she had been paying all year, over $3,000, which combined with her other medical costs would have pushed her over the 7.5% threshold and made itemizing worth it, never discussed. And the credit for the elderly or disabled, which at her income level would have applied, never checked. None of these required her to do anything special. None of them required a complicated strategy or a financial advisor or a lawyer. They required someone who knew to look for them. That is the only difference between a retiree who gets every dollar they are owed and one who sends extra money to the IRS every April without knowing it. This is what I mean when I say the gap between the retiree who keeps their money and the one who sends it to the IRS is not wealth. It is the checklist. Here is your action checklist. 5 things to do before you file or amend. Step 1. Pull out your 2025 tax return. Check line 12 on your Form 1040. Verify that the age 65 or older box is checked. If you or your spouse are legally blind, verify that box is also checked. These are the easiest $200 to $3,000 checks in the tax code. Step 2. Look for Schedule 1A attached to your return. If it is not there and you were 65 or older in 2025 with modified adjusted gross income under $75,000 single or $150,000 joint, you may have missed the senior bonus deduction. Talk to a tax professional about filing an amended return using Form 1040X. Step 3. If you are 70 and a half or older and you have a traditional IRA and you give to charity, call your IRA custodian today and ask about setting up qualified charitable distributions before your next RMD deadline. Step 4. Add up everything you spent on Medicare premiums, supplemental insurance, dental, vision, hearing, prescriptions, and medical-related mileage this year. Divide your expected AGI by 13.3. If your medical costs are anywhere near that number, run both scenarios, standard deduction and itemized before you file. Step 5. If your adjusted gross income is under $17,500 as a single filer or $25,000 as a married couple, ask your preparer specifically about Schedule R and the credit for the elderly or disabled. If they do not know what you are referring to, find someone who does. Barbara filed an amended return. She got back $840. It took one conversation. This is Golden Seniors Hub. If this video helped you find something your preparer missed, hit the like button right now, subscribe and turn on the bell so you never miss a video, and share this with every retiree you know who is over 65 and files their own taxes or uses a preparer who has never mentioned any of these 5 things. Tell me in the comments which of these 5 did you already know about and which one surprised you. I read every single one, and the most common situations become future videos.